You probably think investing is just about picking the right stock or fund, but the real traps are subtle. They don't scream at you. They look like smart decisions. They feel normal. Warren Buffett, one of the most successful investors in history, didn't become a billionaire by luck. He became one by avoiding mistakes most people never even notice. Today, in a world of volatile markets, rising inflation, and constant financial noise, these mistakes can quietly destroy wealth. Let's start with the first mistake. 1. Chasing hot stocks. Imagine a rocket taking off. Everyone wants to hop on, thinking they'll reach the stars. That's what chasing hot stocks is like. When a stock is trending, the price has already climbed. People buy because of fear of missing out, not because of value. Buffett calls this behavior speculation disguised as investing. Why it's dangerous. Markets move in cycles. A company might be popular today, but its fundamentals might not support the hype. Buying at the peak often guarantees a fall. Behavioral science shows humans overreact to recent performance. Studies confirm that most retail investors underperform the market by trying to ride trends. Consider the tech boom of the late 1990s. Many investors piled into dot-com stocks because everyone was doing it. When the bubble burst, they lost 70–90% of their investments. The lesson? A hot tip isn't a strategy. Understanding the business is. 2. Ignoring the power of patience. Investing isn't a sprint. It's a slow, steady climb. Buffett often says, the stock market is a device for transferring money from the impatient to the patient. Yet most people want instant results. They sell winners too early or buy new fads expecting quick gains. Here's the mechanics. Compounding works like a snowball rolling down a hill. Small gains accumulate into massive wealth over decades. But impatience stops the snowball. By selling early, you cut off decades of growth. An example, Buffett bought Coca-Cola shares in 1988 for around $2.50 each. Today, after dividends and splits, that $2.50 has turned into over $700 per share. Most investors would have sold after the first 50% gain. Patience multiplies returns. 3. Over-leveraging and borrowing. To invest debt can feel like fuel for growth, but in investing, it can be a trap. Leveraging amplifies gains, yes, but it also amplifies losses. During downturns, margin calls force you to sell at the worst time. Buffett calls it playing with dynamite. Mechanics matter. If you borrow to invest, a 20% market drop can wipe out your capital and leave you owing money. Without leverage, the same drop is just a paper loss. Behavioral psychology explains why people underestimate risk. They focus on potential gains, ignoring the probability of loss. Historical example, in 2008, many investors using leverage lost everything. Buffett, however, avoided debt for the long-term investments at Berkshire Hathaway. His caution preserved capital and allowed him to buy undervalued companies during the crash. 4. Not understanding what you own. Buffett famously avoids businesses he doesn't understand. He calls it staying within his circle of competence. Yet countless investors buy complex financial products or trendy stocks without knowing how they actually generate money. The trap is subtle. You might read headlines, follow advice, but without understanding the business model, risks are invisible. Warren Buffett says, risk comes from not knowing what you're doing. Consider derivatives or leveraged ETFs. Many investors treat them like regular stocks, but their mechanics are complex and the risks compound. Ignorance often turns a small investment into a total loss. 5. Letting emotions drive decisions. Fear and greed are silent killers. Markets exploit them every day. When prices fall, panic spreads. When they rise, overconfidence grows. Buffett and Charlie Munger often point out that the real enemy is not the market, it's your own mind. The mechanics. The brain's limbic system reacts faster than the rational cortex. Quick emotional reactions can lead to selling low and buying high, the exact opposite of profitable investing. Example, during the 2020 COVID market crash, many investors sold at the bottom, while disciplined investors held and later saw their portfolios rebound. Emotion is an invisible tax on returns. Understanding it is crucial. 6. Ignoring costs and taxes. Even small fees and taxes compound against you. Buffett stresses that minimizing costs is as important as maximizing returns. Mutual fund fees, trading fees, and tax inefficiencies quietly erode wealth. Mechanics. Imagine you have $100,000 invested. A 1% annual fee may seem small, but over 20 years, that's tens of thousands of dollars lost. Add short-term capital gains taxes from frequent trading, and your effective return drops dramatically. Studies show that investors who frequently trade underperform passive, low-cost strategies by significant margins. Costs may look invisible today, but over decades they are wealth killers. 7. Ignoring economic reality. Finally, ignoring macroeconomic factors is a mistake many make. Inflation, interest rates, and global crises affect real returns. Buffett evaluates businesses for their resilience, pricing power, and durability through economic cycles. The trap. Many investors assume markets will always go up. They ignore the impact of rising interest rates or inflation on purchasing power. Mechanical understanding. A 10% nominal gain in a 6% inflation environment is a 4% real gain. Not accounting for reality can mislead your investment decisions. These 7 mistakes aren't mysteries. They are visible if you know where to look. Yet the majority of investors fall into one or more of these traps every year. Chasing trends, rushing decisions, leveraging carelessly, misunderstanding assets, letting emotions rule, ignoring costs, and neglecting economic context. They quietly drain wealth while you think you're investing. In part 2, we'll explore the mechanics behind avoiding these mistakes. You'll see step-by-step strategies used by Buffett, backed by historical data, psychology, and financial science. You'll understand why typical advice fails and how to create an investing approach that compounds safely over decades. Now that we've identified the 7 core mistakes that quietly destroy wealth, it's time to dig deeper. Understanding the mechanics, the data, and the actionable rules behind avoiding these pitfalls is what separates casual investors from those who compound real wealth over decades. 1. Avoiding the hot stock trap. Chasing trending stocks is a classic behavioral trap. Behavioral economists call it the herding effect. People follow the crowd even when fundamentals don't justify it. Historical data proves this. During the dot-com bubble, the Nasdaq rose almost 400% from 1997 to 2000, only to crash 78% by 2002. Those who followed hype lost their capital. Patient investors focused on value saw better long-term outcomes. Buffett's rule is simple: invest in businesses, not stocks. Step 1. Examine the company's earnings history. Step 2. Evaluate its competitive moat. Does it have lasting advantages like brand, scale, or network effects? Step 3. Only buy if the price is below intrinsic value. This method flips the hot stock mentality. Rather than chasing, you wait for opportunity. 2. Mastering patience and compounding. Compounding isn't magic, it's a mechanical principle. A $10,000 investment growing 10% annually becomes roughly $67,000 in 20 years, $174,000 in 30 years. Impatience interrupts this process. Selling early or switching strategies resets the clock. Buffett refers to compounding as the 8th wonder of the world because it's powerful, but only if uninterrupted. Mechanics tip: avoid frequent trading. Choose investments you can hold for 5, 10, or 20 years. Track your returns yearly, not daily. This reduces emotional decisions and allows the snowball effect to operate unimpeded. 3. The danger of leverage debt magnifies outcomes good and bad. Using leverage in investing is mathematically dangerous. Suppose you borrow $50,000 to invest $50,000. A 20% market drop wipes out your equity entirely. Without leverage, the same drop is just a paper loss. Buffett avoids margin for individual investors for this exact reason. It's a gamble with ruin risk. Step-by-step approach to safe investing without leverage. 1. Only use capital you can afford to lose. 2. Keep emergency funds separate from investments. 3. Never rely on borrowed money to buy volatile assets. 4. Reinvest dividends and gains rather than taking out borrowed funds to amplify positions. Leverage tempts the mind with fast growth but punishes quickly when cycles reverse. Buffett uses leverage only at the company level with precise control, not as a retail investor gamble. 4. Stay within your circle of competence. Investing in businesses you don't understand increases risk. Buffett's circle of competence concept is about clarity and simplicity. If you can't explain how a business makes money in simple terms, you likely shouldn't own it. Mechanics. To evaluate a company, answer these questions like: what product or service does it sell? How does it make a profit consistently? What risks could permanently reduce its value? Example: Buffett avoided tech stocks for decades because he didn't understand their long-term business models. Those who invested heavily in tech early often suffered massive losses during downturns. Understanding mechanics is more important than chasing high-growth labels. 5. Managing emotions in volatile markets. Fear and greed are predictable forces. Historical market data reinforces this. During the 2008 financial crisis, the S&P 500 dropped 37% in a single year. Many investors sold at the bottom, locking in losses. Those who stayed calm and invested additional capital saw remarkable recoveries. Practical approach. Set predetermined rules for buying and selling, not emotional reactions. Use dollar-cost averaging to remove long-term trends instead of daily volatility. Buffett emphasizes that mastering emotional discipline can create more wealth than stock-picking skill. The market is a mirror reflecting collective psychology, not rational pricing. 6. Reducing costs and taxes. Costs are invisible until they accumulate. For example, a 1% annual fee on a $100,000 portfolio over 30 years can reduce final wealth by more than $50,000. Taxes amplify the drag. Short-term capital gains can reach 30% in many jurisdictions. Step-by-step strategy to minimize costs. 1. Use low-cost index funds or ETFs. 2. Hold investments long-term to benefit from lower capital gains rates. 3. Reinvest dividends to maximize compounding. 4. Compare fees across funds regularly. Small differences compound over decades. Buffett calls avoiding unnecessary costs the first step in investing success. It's mechanical, measurable, and and under your control, unlike the market. 7. Accounting for economic realities. Ignoring macroeconomic factors can silently erode wealth. Inflation, interest rates, and recessions impact purchasing power and real returns. Mechanics. If inflation averages 6% annually and your portfolio grows 8%, your real gain is only 2%. Over decades, ignoring inflation dramatically reduces purchasing power. Buffett evaluates businesses for durability, pricing power, strong cash flow, and resilience to economic cycles. Actionable steps. 1. Focus on companies with strong pricing power. 2. Maintain a diversified portfolio to manage macro risks. 3. Avoid assuming the market will always rise. Plan for downturns. Buffett's long-term approach incorporates reality into decision-making rather than wishful thinking. Historical returns confirm that investors who account for inflation, interest rates, and cycles preserve capital and compound wealth effectively.